You think you are making financial decisions. You are not. Every purchase you make, every app you open, every search you run, every location you visit, every card you swipe, every loan you apply for, every subscription you maintain, every item you browse without buying, all of it is being recorded, analyzed, scored, sold, and used to make decisions about you that you will never be shown and never be asked to approve. The financial system you interact with every day is not a neutral infrastructure for moving money. It is a surveillance apparatus of extraordinary sophistication that treats your behavior as its primary product. You are not the customer of this system. You are its raw material. The data your financial life generates is more valuable to the people at the top of this system than the fees they collect from you. The fees are the excuse for the relationship. The data is the point. This is not a future threat. It is not a theoretical risk. It is happening right now, in real time, with every transaction you make and every digital footprint your financial behavior leaves. The infrastructure for complete financial surveillance of ordinary individuals has been built quietly over the last 3 decades, piece by piece, app by app, terms of service agreement by terms of service agreement, until it is now so comprehensive and so deeply embedded in daily life that most people cannot imagine functioning without it. And the people who built it are not governments. They are corporations. Corporations whose business model depends on knowing more about your financial behavior than you know about yourself. Corporations who have discovered that your financial data, your spending patterns, your debt levels, your income fluctuations, your risk tolerance, your financial anxieties, is worth more than anything they could sell you directly. Understanding this system is not optional if you want to make genuinely free financial decisions. Because right now, the decisions you believe are free are being shaped, nudged, and manipulated by people who know your financial psychology more intimately than your closest friends. Before apps, before smartphones, before big data and machine learning and behavioral analytics, there was the credit score. And the credit score was the first and most consequential experiment in using financial behavior surveillance to control financial access. The credit score is presented to you as a neutral measurement of your credit worthiness, a fair, objective reflection of how responsibly you manage financial obligations, an impartial number that simply reflects reality. It is none of those things. The credit score is a proprietary algorithm owned by private corporations, primarily FICO, that processes your financial behavior according to criteria that are not fully disclosed, weighted by factors whose relative importance is not fully transparent, producing a number that determines your access to housing, employment, credit, and financial services. The algorithm is private. Its full weighting is not public. The companies producing it answer to their shareholders, not to you. Think about what this means in practice. A 3-digit number produced by a private corporation using undisclosed methodology determines whether you can rent an apartment, what interest rate you pay on a mortgage, whether you can get a car loan, in some cases whether you can get a job. This number follows you everywhere. It affects decisions made about you by parties you will never meet, using criteria you were never fully told about. And the behaviors the credit score rewards are not simply responsible financial behaviors. They are behaviors that maximize the extraction of profit from you by the financial services industry. Maintaining balances on credit cards, not paying them off in full, improves certain aspects of credit utilization modeling. Having multiple credit accounts active simultaneously is rewarded. The credit score system rewards the behaviors that keep you engaged with credit products, because the companies scoring you are the same industry that profits from your engagement with those products. The credit score was never designed to serve you. It was designed to serve lenders, to standardize the process of determining how safely they could extract interest from you over time. You are not the beneficiary of the credit score system. You are its subject. The score tells lenders about you. It tells you almost nothing about them. Your bank has more data about your financial behavior than any other institution in your life. Every transaction you make, every coffee, every grocery run, every streaming subscription, every impulse purchase at midnight, every transfer to savings that lasts 3 days before being moved back, is recorded, time-stamped, categorized, and stored. This data tells a story about you that is more accurate and more intimate than any survey or interview could produce. It shows not what you say you value, but what you actually spend money on. Not what you claim your habits are, but what your habits actually are. Not the financial self you present to the world, but the financial self that exists in reality, transaction by transaction, 24 hours a day. Banks have known for decades that this data is extraordinarily valuable. But the historical limitation was that processing and analyzing transaction data at scale was technically difficult and expensive. That limitation no longer exists. Machine learning systems can now process millions of transactions per second, identify behavioral patterns invisible to human analysis, and generate psychological profiles of financial behavior with accuracy that would have seemed impossible 20 years ago. What your bank can now determine from your transaction history alone is staggering. Your approximate income and income stability, your debt obligations and debt-to-income ratio, your spending patterns by category and how those patterns change under stress, your impulse control, literally measurable through the ratio of planned purchases to unplanned purchases, your financial anxiety levels, measurable through patterns of checking account balances, through overdraft proximity, through the timing of transfers relative to payment due dates, your relationship status, family composition, and major life events, all of which leave unmistakable signatures in spending patterns. And what does your bank do with this data? Some of it is used to manage their risk exposure to you. Some of it is used to decide which products to offer you and when. Some of it is sold to data brokers who aggregate it with data from other sources to build profiles that are sold to insurers, employers, marketers, and other financial institutions. Some of it is shared with credit bureaus, and some of it is used in ways that the terms of service you agreed to permit, but were designed specifically to prevent you from understanding before agreeing. The checking account you use for daily transactions is not just a financial tool. It is a data collection device whose primary product is your financial behavior. The smartphone changed financial surveillance from something that happened at the institutional level to something that happens in your pocket every moment of every day. Financial apps, budgeting apps, investment apps, payment apps, buy now, pay later apps, crypto apps, personal finance management apps have created a new category of financial surveillance that most people enthusiastically opt into because the apps offer genuine value while simultaneously collecting data whose value to the app operator dwarfs the value of the service being provided. Consider what happens when you connect a budgeting app to your bank accounts. The app can now see every transaction across every account. It categorizes your spending, shows you trends, helps you set budgets. The service is real and genuinely useful. And simultaneously, you have handed an entity, in most cases a private company with undisclosed data practices, complete visibility into your entire financial life. What does this company do with that visibility? The business model of most free financial apps is not the service they provide. The service is the acquisition mechanism for the data. The actual business model is what the data enables. targeted financial product offers, data sales to third parties, behavioral profiling that is sold to lenders and insurers, and in some cases, dynamic pricing of financial products based on what your behavioral data reveals about your desperation or your options. Mint, one of the most popular personal finance apps in American history, was acquired by Intuit, the company that owns TurboTax and QuickBooks, specifically because the financial behavioral data it had collected on millions of users was extraordinarily valuable for cross-selling financial products and informing the pricing and eligibility decisions of Intuit's other financial services. You use the app to track your spending. Intuit used your data to know more about your financial psychology than you do, and to sell financial products calibrated to your specific vulnerabilities and your specific willingness to pay. This is the standard business model of the financial app economy. The app is not the product. You are. Your data is. And the more completely the app can see your financial behavior, the more valuable you become as a data source. The buy now, pay later industry is one of the most significant developments in consumer financial surveillance of the last decade. And it has been so successfully marketed as a consumer benefit that most of its users do not understand what they have actually opted into. Buy now, pay later services, Klarna, Afterpay, Affirm, and their competitors, offer consumers the ability to split purchases into installments, often with no stated interest. The service is presented as a consumer-friendly alternative to credit cards. Free financing, flexible payments, no interest. What it actually is, a data collection mechanism that captures financial behavior at the point of purchase with extraordinary granularity, combined with a debt product that specifically targets people who cannot afford to pay full price in a single transaction. The data that buy now, pay later companies capture is more granular than traditional credit data, because it captures not just whether you pay your debts, but what you buy, when you buy it, how you split your payments, whether you pay early or late, and how your purchasing behavior changes when you are given access to credit at the point of purchase. This behavioral data is extraordinarily valuable to lenders, insurers, and marketers who want to understand not just your credit worthiness, but your financial psychology. The debt product targets a specific consumer, someone who wants something they cannot currently afford and is willing to commit future income to acquire it immediately. This is the same psychological mechanism as a credit card, but without the credit card's friction and without the credit card's established regulatory framework. The installment structure makes the total cost of the purchase feel smaller because it is divided into pieces, exploiting the psychological principle that we evaluate prices in absolute rather than relative terms. 4 payments of $30 feel significantly less expensive than $120, even when they are identical. And the no-interest claim deserves examination. Buy now, pay later services make money from the retailers who offer them, charging merchants a percentage of each transaction significantly higher than credit card processing fees. They make money from late fees on missed payments, and they make money from the data their users generate, which is sold or used to offer additional financial products to users whose behavioral profiles indicate specific financial vulnerabilities. The consumer pays with their future income. The company collects the merchant fee, the late fees, and the data. The value exchange is not what it appears to be. The insurance industry has undergone a silent revolution in the last decade that most policyholders are entirely unaware of. The revolution is behavioral pricing, the replacement of broad demographic risk categories with individual behavioral profiles as the basis for insurance pricing. Traditional insurance pricing used broad categories: your age, your location, your vehicle type, your claims history. These are blunt instruments. They tell insurers roughly how risky you are based on how risky people like you tend to be. But they say nothing about you specifically. Two people of the same age in the same city driving the same car were priced similarly because insurers had no way to distinguish between their individual behaviors. That limitation is gone. Usage-based auto insurance programs, marketed under names like Progressive's Snapshot or Allstate's DriveWise, offer premium discounts in exchange for installing a device or app that monitors your driving behavior in real time. Speed, braking intensity, acceleration patterns, time of day, miles driven. Every aspect of how you actually drive is recorded and used to price your insurance based on your individual behavior rather than demographic averages. Most people who opt into these programs do so for the initial discount without fully understanding that they are permanently converting their relationship with their insurer from one based on demographic pricing to one based on individual behavioral surveillance. If your data reveals that you are a better risk than average, your premium decreases. If it reveals that you are a worse risk, your premium increases. You lose the discount, or in some cases, you are quietly non-renewed. And this is only the beginning. Health insurers are developing behavioral pricing models based on wearable device data. Step counts, sleep patterns, heart rate variability, exercise frequency. Life insurers are experimenting with social media analysis to assess lifestyle risk. Home insurers are using smart home device data to assess property risk. The direction of travel is unambiguous. Every insurable behavior will eventually be monitored, and every insurance premium will eventually be individually calibrated to the behavioral data you generate. The monitoring is presented as empowerment. You control your premium through your behavior. The reality is surveillance. Your most intimate daily behaviors are being continuously recorded and used to extract the maximum premium your individual risk profile justifies. The surveillance of your financial behavior extends beyond the financial services industry into the employment relationship in ways that most people do not realize are legally permitted and increasingly common. Employers in most American states can access your credit report as part of the hiring process. Not your credit score, your full credit report, which shows your debt levels, your payment history, your accounts in collections, your bankruptcies, and your overall financial picture. The justification offered for this practice is that financial stress predicts certain types of workplace behavior: theft, fraud, distraction, that employers have a legitimate interest in screening for. What it actually does is create a systematic employment barrier for people who have experienced financial hardship, medical debt, job loss, divorce, predatory lending, regardless of whether that hardship reflects on their professional competence or their personal character. The financial surveillance of your life determines not just what credit you can access and at what price, but whether you can get the job that would allow you to improve your financial situation. The circularity is perfect and devastating. Financial hardship produces bad credit. Bad credit prevents employment. Inability to get good employment perpetuates financial hardship. The surveillance system that was supposed to make credit markets more efficient has created a permanent underclass of people whose past financial difficulties prevent the employment that would allow them to overcome those difficulties. And the employer credit check is the visible end of a much larger iceberg. Data brokers compile comprehensive financial behavioral profiles, drawing from public records, transaction data, app usage, social media, location history, and dozens of other sources that are sold to employers conducting background checks outside the formal credit reporting system. The Fair Credit Reporting Act regulates formal credit reports. It does not regulate the data broker industry that has grown up alongside it. The comprehensive financial behavioral profile that a data broker can compile on you has no regulatory framework governing its use in employment decisions. The most disturbing aspect of financial behavioral surveillance is not what it reveals about you to others. It is that it reveals things about you that you do not know about yourself. The behavioral analytics systems processing your financial data are not simply recording what you do. They are identifying patterns in your behavior that predict future behavior with accuracy that exceeds your own self-knowledge. They know when you're about to make a major purchase before you have consciously decided to make it. They know when you're experiencing financial stress before you have acknowledged it to yourself. They know your susceptibility to specific types of offers based on the timing and emotional context of your past purchases. They know your price sensitivity, your brand loyalty thresholds, your debt tolerance, and your response patterns to financial marketing with precision that decades of self-reflection could not produce. This asymmetry of knowledge is the foundation of the modern financial extraction system. Every financial product offer you receive is calibrated to what the data reveals about your specific psychology. The credit limit increase offered at the moment your account data suggests you are most likely to use it. The buy now, pay later option appearing at the exact price point above which your transaction data shows you hesitate to pay in full. The insurance product pitched at the moment your behavioral data suggests you are experiencing the specific anxiety that product is designed to address. You are making decisions in response to offers that were designed using more knowledge of your psychology than you have access to yourself. The information asymmetry is total, and it is deliberate. The system profits from knowing you better than you know yourself, and using that knowledge to guide your decisions toward outcomes that serve the system rather than you. The surveillance is real, its scale is real, and its implications for your financial autonomy are serious. But understanding the system changes your relationship to it in ways that matter. Pay with cash when possible. Cash transactions leave no data trail. The friction of cash is deliberate. Digital payments are easier, not just for your convenience, but for the data collection that your convenience enables. Every time you choose cash, you choose privacy. Read the permissions you grant financial apps before granting them. The data access a budgeting app requests, access to all accounts, transaction history, contacts, is not necessary for the service it provides. It is necessary for the business model that the service disguises. If an app's permissions are broader than its function requires, the excess permission is being requested for data collection, not service delivery. Understand what your credit report actually contains and review it regularly. You are entitled to free annual credit reports from all 3 major bureaus. The report shows what the surveillance system has recorded about you. Knowing what it contains is the minimum requirement for managing your relationship with a system that uses that information to make consequential decisions about your life. Opt out of behavioral data collection programs where the opt-out is available. Usage-based insurance programs. Retail loyalty programs. Financial app data sharing settings. In most cases, the opt-out exists but is not prominently offered because the company's economic interest is in your opting in. And most importantly, understand that every financial decision you make is being watched, recorded, and used. Not to help you, to extract from you. The system's interest in your financial behavior is not benevolent. It is commercial. And knowing that changes how you engage with every app, every offer, every terms of service agreement, and every financial product that presents itself as being designed for your benefit. The surveillance is the product. You are the raw material. Now you know what you are dealing with.